Are you tired of hearing about the Fed bailing out big banks while ordinary people struggle to make ends meet? Well, it's time to pay attention because the latest bailout news is making waves. In this video, we'll break down what's really going on with the Fed's recent bailout and what it means for you, your money, and the economy. Get ready to be shocked and maybe even a little outraged as we dive into this controversial topic. Don't miss it. After the recent failure of two major banks, the U.S. government has stepped in with a bailout program to prevent further economic turmoil. Silicon Valley Bank was the first to suffer losses and was subsequently closed down by federal authorities. Don't forget to subscribe to our channel and hit the notification bell to watch our latest videos as soon as they are released. This caused panic among depositors who rushed to withdraw their funds and left the bank without the necessary capital to continue operating. The situation was compounded over the weekend when Signature Bank also failed. In response, the FDIC has established bridge banks to manage both insured and uninsured customer deposits. This move is aimed at reassuring depositors that their funds are safe and accessible. While the bailout program has been met with mixed reactions, many are hopeful that it will prevent further bank failures and provide much-needed stability to the economy. In response to the recent bank failures and the resulting economic instability, the Federal Reserve has announced the Bank Term Funding Program (BTFP). This program will provide loans of up to 1 year to eligible depository institutions such as banks, credit unions, and savings associations, using qualifying assets such as US Treasuries, agency debt, and mortgage-backed securities as collateral. Comment inflation if you would like us to make more videos like this in the future. The loans will be offered at face value, which will help the institutions avoid the need to sell their securities quickly in times of stress. The BTFP aims to provide additional liquidity to banks, thereby ensuring that they can meet the needs of all their depositors. The US Treasury will provide credit protection of $25 billion to the Fed from the Exchange Stabilization Fund, which will help prevent another bank failure like that of Silicon Valley Bank. The loan program has been met with mixed reactions, but many experts agree that it is a necessary step in stabilizing the economy and preventing further bank failures. It remains to be seen how effective the BTFP will be in achieving these goals, but it is clear that the Federal Reserve is taking decisive action to address the current economic challenges. The backdrop: Silicon Valley Bank (SVB) suffered significant losses after selling a large portion of its bond portfolio at a loss of $1.8 billion last week. According to CEO Greg Beck, the decision to sell was due to the expectation of continued high interest rates, pressure on public and private markets, and elevated cash burn levels from clients. SVB had purchased the bonds when interest rates were low, but the rising interest rates caused the value of the portfolio to plummet. The bank planned to sell lower interest rate bonds and reinvest in higher yielding, shorter duration bonds. Unfortunately, the sale caused panic among depositors and weakened the bank's balance sheet. This situation is not unique to SVB. Many U.S. banks are facing similar challenges as the Fed raised interest rates to combat price inflation, resulting in the decimation of the bond market. Don't forget to like this video if you've watched it till now, as it inspires us to make content like this. Banks have not been able to adjust their bond holdings quickly enough, leaving them undercapitalized on paper. The banking sector had nearly $620 billion in unrealized losses on securities at the end of last year, according to the Federal Deposit Insurance Corp. This highlights the need for swift action to stabilize the banking sector and prevent further economic turmoil. The Bank Term Funding Program (BTFP) provides a lifeline to banks struggling to deal with the fallout from rising interest rates and falling bond prices. Banks can now borrow from the Fed against their assets at face value instead of selling them at a loss in the open market. However, this move by the Fed will also create inflation. Essentially, the Fed will print new money out of thin air to loan to banks, increasing the supply of money in the market. This can cause prices to rise and the value of money to decrease. Furthermore, the Fed is manipulating the bond market by encouraging banks to hold treasuries instead of selling them. This artificially limits the supply of treasuries, causing prices to remain higher than they would otherwise be. Peter Schiff, a well-known economist, has suggested that this could result in the biggest round of quantitative easing yet. The long-term effects of these policies remain to be seen, but they are likely to have far-reaching consequences for the U.S. economy and beyond. Is this a potential bailout? While the government may claim that the Bank Term Funding Program BTFP is not a bailout, the truth is that it absolutely is a bailout. The BTFP allows banks to access the capital they would not otherwise be able to access under normal market conditions. Furthermore, uninsured depositors will receive their money back. While the government may argue that they are not directly bailing out failing banks such as SVB or Signature Bank, they are providing a way for these banks to avoid collapse and are ultimately bailing out insured depositors. Moreover, the loan program and deposit guarantee serve as a signal to other banks that they will not be allowed to fail, thus reducing the likelihood of bank runs. It is important to recognize that the government's actions are not without consequences. While the BTFP may provide temporary relief to struggling banks, it also creates inflation and distorts the bond market. The long-term effects of these policies are uncertain, but they are likely to have far-reaching implications for the U.S. economy and the financial system. Will the money be paid with the taxpayers' fund? The claim that this bank bailout won't cost taxpayers directly is not entirely true. Although the government may not raise taxes to fund the bailout, taxpayers will still be impacted by the inflation tax. When banks borrow money from the Fed, they effectively increase the money supply, which can lead to higher prices for goods and services. Moreover, the government may eventually have to tap into the $25 billion credit protection extended by the US Treasury if any of the banks that take loans default. This would ultimately result in taxpayers footing the bill for any losses. This is not the first time the US government has bailed out banks. In 2008, the government implemented the Troubled Asset Relief Program (TARP) to rescue banks that were deemed too big to fail. TARP ultimately cost taxpayers billions of dollars, and some argue that it set a dangerous precedent for future bailouts.